Welcome to vTalkInsight, Risk Sentiment Daily for January 5th, 2026. Markets are stepping into 2026 with strong optimism around artificial intelligence and earnings, but also with late-cycle worries around yields, politics, and consumers starting to build. Let us unpack how those forces are shaping today's risk sentiment. Across assets, today's tone is best described as cautiously risk-on. After a late 2025 period that felt very two-way, expectations for another strong year in U.S. equities, anchored by artificial intelligence momentum and accelerating S&P earnings, are pulling investors back toward risk. Portfolio managers are starting the year with more risk appetite, reversing the caution seen into year-end, and early flows are favoring laggards, small caps, and regional banks as investors look beyond last year's winners. The equity rally is also broadening internationally, with more capital rotating into non-dollar assets and emerging markets. At the same time, implied volatility across equities, bonds, and currencies remains low, even as midterm elections, fiscal deficits, and questions over Federal Reserve leadership are flagged as potential volatility catalysts later in the year. Add in concerns about stretched valuations, tight credit spreads, and pockets of consumer and electric vehicle weakness, and it is clear investors are leaning into the upside, but staying alert to late-cycle downside scenarios. AI and tech-led growth momentum remains the single most powerful bullish driver in today's market narrative. 2026 is widely viewed as a pivotal year, with forecasts calling for tech stocks to rise around 20 to 25% as AI monetization spreads beyond just the largest technology firms. Big technology companies are expected to spend roughly $600 billion in capital expenditure, fueling an AI arms race across data centers, chips, and software. Demand for AI hardware continues to outpace supply, supporting companies like NVIDIA, Micron, and Broadcom, while vertically integrated players such as Microsoft and Google are seen as having durable advantages through in-house chips and proprietary data. This investment wave is lifting earnings expectations, with tech sector profit growth projected in the mid-20s and the Magnificent Seven still providing a large share of index-level profits. The risk is that valuations in these names are already rich. Wall Street consensus on a tech-led rally is unusually strong, and any disappointment on AI demand, regulation, or rates could see high beta leaders correct sharply, so investors are watching for signs of fatigue even as they lean into the structural trend. Beyond AI, broadening earnings and equity market breadth are key supports for sentiment. All 11 S&P sectors are forecast to grow earnings in 2026, something not seen for several years, and projections call for S&P profits to rise around 10 to 14%, with revenue growth in the mid-single digits. Earnings growth outside the largest tech names is expected to accelerate, narrowing the gap with the Magnificent Seven and helping reduce concentration risk. Cyclical areas such as industrials, financials, railroads, automation, and select consumer and animal health names are highlighted as beneficiaries of stronger nominal growth, while communication services offers a blend of double-digit top line and margin expansion with some defensive characteristics. Internationally, a broadening of the equity rally beyond the United States has already driven meaningful portfolio diversification into non-dollar assets, and emerging market bonds and currencies are drawing interest on the back of disinflation and attractive real yields. The main caveats are that index performance is still heavily reliant on the top tech stocks, credit spreads in both investment grade and high yield remain very tight, and past episodes of early year rotation into Europe and other laggards have sometimes faded quickly if macro conditions fail to improve as hoped. Fed easing, disinflation, and a broadly supportive policy mix form the third major bullish driver. Markets expect the Federal Reserve to cut rates by up to 3/4 points this year, helped by moderating shelter costs, subdued hiring, and inflation data that confirm policy is still restrictive. Some forecasters see the neutral rate drifting back toward pre-pandemic levels near 2%, which would reinforce lower discount rates and support higher equity valuations if realized. Treasury issuance strategies and potential buybacks are also expected to help anchor long-term yields in a roughly 3.75 to 4.25% range on the 10-year, even as front-end rates decline. Fiscal policy is set to remain expansionary with stimulus and potential tax cuts adding to growth, and regulators appear to be easing the capital burden on banks, enabling more lending and capital return. However, strong economic tailwinds have already led some to argue that the Fed may cut less than previously thought, and if inflation or fiscal concerns push long yields higher, the supportive impact of lower short rates could be more than offset. On the bearish side, fiscal-driven yield risk and valuation stress loom large over this cycle. Persistent budget deficits and heavy Treasury issuance are seen as underappreciated threats that could push term premia higher and keep the long end of the curve elevated, even while the Fed is cutting policy rates. There is explicit concern that a move in the U.S. 10-year yield back toward 5%, whether from inflation surprises or supply stress, could trigger a rapid derating in equities as higher risk-free returns compete directly with stocks. At the same time, high levels of corporate and government bond issuance, including from tech firms funding AI projects, risk meeting more cautious demand from bond investors who are already demanding higher risk premiums. Corporate spreads are historically tight, high-yield risk premia sit near post-crisis lows, and analysts note that valuations across U.S. equities, AI stories, and even some precious metals now embed very optimistic scenarios. While Treasury management actions may stabilize the curve and recent disinflation data argue against a renewed hiking cycle, any sustained rise in real yields or spike in supply concerns could force a broader valuation reset across growth equities and credit. Consumer and labor strain in late cycle is another important constraint on risk appetite. U.S. consumer spending has remained resilient so far, with the top 10% of earners accounting for roughly half of total outlays, but sentiment has deteriorated sharply and measures like the Conference Board Index sit at their weakest levels since the pandemic. Real disposable income growth was flat in the third quarter, rising household costs continue to outpace wage gains, and more households are relying on debt and credit to sustain spending, all of which point to increasing financial stress beneath the surface. The expiration of enhanced health care tax credits, expected to leave nearly 5 million people without coverage, adds another drag on discretionary spending capacity. These pressures are already visible in rate-sensitive and discretionary sectors. Housing remains weighed down by elevated mortgage rates, and electric vehicle demand is slowing as key tax credits roll off, with Tesla and other automakers facing weaker deliveries and profitability challenges that have led some firms to scale back investment plans. While robust business investment in AI and selective strength at the high end of retail help offset these headwinds, any meaningful deterioration in the labor market could quickly turn cautious sentiment into a pullback in consumption and earnings. Finally, election, Fed leadership, and geopolitical uncertainty are hovering over the benign near-term backdrop. Historical patterns show U.S. equities often struggling in midterm election years, and two bear markets in the last decade coincided with such cycles, which helps explain concerns that today's very low volatility may not persist. Uncertainty around the Federal Reserve Chair role and the prospect of a politically driven shift in the composition of the policy-making committee raise questions about the central bank's independence and future reaction function. Leadership changes have frequently lined up with periods of market stress, and investors worry that aggressive fiscal policy combined with political pressure on the Fed could amplify volatility in rates and risk assets. On top of domestic politics, global flashpoints from Taiwan to the Middle East are seen as potential catalysts for supply chain shocks in semiconductors, rare earths, and energy markets, with scenarios involving sanctions and trade disruption echoing the Russia-Ukraine experience. Some recent sanctions have been more symbolic than binding, and the U.S. has taken a somewhat softer tone toward China, but the underlying rivalry over technology and resources keeps a layer of geopolitical risk embedded in every cross-border allocation decision. Stepping back, risk sentiment as we start 2026 is cautiously risk-on, powered by AI and tech-led growth, broadening earnings strength, and an easing-leaning policy backdrop, yet constrained by fiscal-driven yield risks, signs of consumer and labor strain, and a year of elevated political and geopolitical uncertainty ahead. The balance of forces points to ongoing opportunity in risk assets, but with a much lower margin for error around growth, inflation, and policy surprises than earlier in the cycle. Watch how long-term yields trade against earnings expectations, whether consumer data validate the soft landing narrative, and how volatility behaves as the election calendar and Fed leadership debates move to the foreground. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.